So when we were looking at the most recent narrowing of the channel in here, we recognized that we were starting to put in supply at the top, and we were starting to squeeze the demand. Remember, this demand vanished into a singularity just here. So when the demand vanishes into a singularity, what happens? Well, we end up getting volatility. Because when you get that singularity, then of course it's used for one of two things. Either it's going to be absorbed and reversed, or it's going to be broken out. So in the two examples that we've got, when that singularity appears, we've got one there that's used as a reversal, and then we've got one here that's used as a breakout sell. So obviously the key idea here is already established. If you see them using it as a reversal, it's probably going to break on the other side. Does that make sense? Because the market's not normally skewed on both sides. If you've got that situation in the market space where we know that there is a fat tail event, which we know is called kurtosis, when you get that kurtosis coming into a fat tail narrative, it usually contains a skew. Now, obviously, when you've got fat tails, it can be, for example, non-farm payrolls, it can be CPI prints, it can be a data release coming out, so you've got fat tails at both sides. And if you've got fat tails at both sides, what are you kind of expecting? Of course, you're just expecting volatility. The best play there is, of course, to try and straddle it with a buy put buy call order if it's cheap enough to do it. But obviously, because they've got fat tails, it's already designed to be a high-priced product, and therefore it's very difficult to get into those products without paying a massive premium to take advantage of the fat tails. But you've got the ability to see fat tails without paying option prices. You can see that when you get volatility squeezing to these two singularities, you start recognizing that the fat tails are starting to appear. But you've also recognized that they used this potential fat tail, because if they use this potential fat tail for a sell trade, then of course what that means is that we actually start developing a skew with a fat tail. Does that make sense? And obviously at that stage there, the skew with the fat tail becomes kind of bearish against this one here, and we're going to be expecting this to start squeezing through some of these areas. And as we go, we start heading into these demand prints at the bottom edge. We start recognizing the demand prints at the bottom edge. We had one up obviously here, which took us to this price here. And then, of course, we've got another demand print here, which took us to this point here. So we have these demand areas that we move between. So when this price starts to take out this guy here, of course, then we're moving to this guy here, and we have to make a decision. If that comes out, we're going to be moving to this guy here. And then if that comes out, we're obviously going to move to the very bottom edge demand narrative. So can everybody understand that concept of fat tails? Can everybody kind of get their heads around this? Now, why did we sell it in the first place? Well, here's the reason why. We'd already talked about macro sell side value. We recognized that short term the value went kind of neutral. But look at what happened just as we got into that level 2 liquidity here. The value collapsed again, didn't it? So the value collapsed again, having been what looked like very bullish. Now, I'm expecting a sell side opportunity. But when the value collapsed here and we started to sell into this pocket liquidity here, then I'm going to be very, very keen to work into this as a sell trade. Because obviously if we start squeezing into this paycheck area here, it's a very, very thin paycheck area here, there's a lot of fat tail to take advantage of. And when we squeeze, of course, we went sell side 41.50s to sell side 41.15s. And obviously that's a $3,500 profit, bearing in mind this is just a 1 minute chart, and that's taken approximately 45 minutes. Now, 45 minutes is still 45 minutes. So let's think about this concept of, let's think about this briefly, this concept of fat tails and skews and kurtosis as far as three elements are concerned. Now, I think everybody understands the concept of fat tails, so we'll just use the word fat tails because I think it's quite descriptive. So I think we'll use that instead. So the idea, of course, of a fat tail is people think it's the same as skew, but it's not the same as skew. Because obviously skew can result in a fat tail on one side, but then you've already recognized that it's got a skew, right? So when we look at a skewed market, this is what it looks like from a profile point of view, that type of idea. So when we're looking at this as an idea, then of course the simple idea here is that there seems to be a fat tail opportunity to the right-hand side here. So you'd imagine that if we start recognizing that that is where it's going, we would imagine that this is normally going to flatten out again into this this type of narrative here as we go towards an extreme that starts to give us like a zero print exhaustion type idea. And we end up with what looks more like a normal distribution, of course, at that point. Now, obviously, it's going to be very, very interesting to see that, but how do we start coming across that question? Well, of course, this idea of a supply line and a demand area, that's got nothing to do with this drawing, by the way, but a supply area followed by a demand area, followed by a supply area, followed by a demand area. Well, obviously, what's going to start happening is we're going to start watching for one of these two to collapse. So what we're going to start looking at is we're going to start looking for a rejection of any particular area, because that means that we're going to collapse the other area down to zero. And that's going to start giving us what we know as a fat tail stroke skew, because obviously we start getting an idea of whether we agree with it or not, we can at least see it. So what happens? Well, of course, this means that the price is trading in this area here. It's moving between these two prices. That's why we've got the lines in the first place. And then we can obviously recognize this, what we call a narrowing channel phase here. Now, obviously, the key to this is recognizing that the skew can be developed from something very simple. When the price breaks to the top side or the bottom side, we start recognizing a read. So when it breaks to the top side, for example, here, or even if it breaks to the top side here and it starts rejecting, we start getting an idea that this one here is now up for question. So if that starts rejecting there, what's the chances that this one will stay? Pretty remote, based on the fact that this supply stayed very valid. So if this supply stays valid, this demand is very questionable. It doesn't necessarily mean that this demand's questionable, but this one's going to collapse to zero. So the very idea is that we should at least go back to this price here. If we go back to this price, then of course the question is, do we then go into this area here and then accept this, or do we go into this area and collapse it back to this point here? So that's going to be the next question that we're asking is, do we collapse it all the way back to here? And then when we get there, we ask exactly the same question again. And we keep asking that same question, because now this is agreed, and now we've got a brand new demand area that's just shown up on the charts, which is now wherever this pivots through to, wherever we see new selling coming in is where the new supply area starts from. So when you see that story, you start recognizing that developing out a skew story does come from this squeeze of trade. And when we look back at the trade again, and we can see other areas where this stories came to light, then of course we can start recognizing how this can start happening, how we can start seeing this live on our own screens. You know, when you're looking at an area like this and you start recognizing, for example, you recognize that this is starting to see some supply coming in, we've got some demand coming in, so that's okay, we've got that story. We've got a pivot down here, so we recognize that there is a demand pivot from that price there. Now we can also recognize that prior to that, we've now got supply coming in. So obviously what we've now got is technically a narrowing. It's got a very bullish bias at that stage, but we do have a narrowing. So what we understand is, if we start squeezing that narrowing already, now I'd rather see some supply at lower prices. So when I see that sell coming in here, because I haven't seen any other sells, it's still perhaps questionable, but when I see a sell coming in there, I'm at least expecting it to collapse back towards this price here. So I'm starting to play that with a sell side skew. I'm starting to think that there is a possibility of a sell side skew. Now, in this occasion, it didn't happen, and what happened was instead we got new demand showing up, and that's okay, because new demand showing up here, well, guess what? That's going to collapse the supply back towards the top edge, isn't it? So the supply here that was in at this point, well, that's going to collapse into this point here, and we're going to start getting a brand new story at that stage. This demand is now verified and is now strong. So obviously from that point, we've now got the demand squeezing up into this pivot here. So when this pivot trades, what I'm now looking for is I'm looking for the supply to pressure on this here. Now at this stage here, you're not expecting it, but obviously if it starts putting pressure on this guy, this price is now sell side. So what happens? Well, of course we rally, and this looks like a very strong bullish demand area, but then the supply comes back in again, and you say, well, wait a minute, that supply coming back in here, the guy that's bought this is going to get squeezed. It's called a failed auction, and it's called the interns exercise. The fact that you've gone below the black line here makes it a sell on the interns exercise, but only if you see a sell coming in. It's not a sell on this green candle or a sell on the rally through this phase. It's a sell when the sell comes back in here. It's a sell for the BSG squeeze or the tipping price sell trade when you're going after this guy here, because this is the next liquidity that's up for grabs. So you go after the sell here. This is the interns exercise, and we get the squeeze on. And when we take this demand down to a single point, so we collapse the demand, well, we're now going for this point. So we take the first target price, the second target price, and ultimately the third target price on the drop phase. And that was a perfect example of finding the best trade going after the weak liquidity. It comes back to my tweet from earlier that, we asked 2 questions, and just 2 questions only. And the question is, if you can answer these 2 questions, you can almost eliminate all losses. Almost. It doesn't mean your bad execution gets you out of a hole, but you can at least trade in the right direction of the market. And that is, can you identify target weakness? In other words, that you're collapsing supply or demand. And are you trading towards it? It's amazing how important that is. We sometimes call it a lean or a Charlie D reversal when we start getting it rejected. But if you're trading away from that weakness, it's a passive fade and it's dangerous to do it. When you turn back towards the weakness, you've got a very high probability trade starting to work in your favor. Well, we've identified that this demand which is collapsing, we've identified that this push to the downside, this trade is now trading towards that weakness. And therefore, if you can get in fast enough, what you're looking for is a buy order on this candle, followed by a sell order, or a buy order followed by nothing except for a rejection. And what you're trying to do now is capture that weakness, go after the weaker side, and then play all in on this one, because this is a top edge fade. You're not trading to weakness. You're trading from weakness. That's a different thing. If I want to trade toward weakness, this is the trade here. This is the one you must try and be on if you haven't got this trade on, or if you don't want to do this trade, this is the trade you must be on here. And for that reason, of course, this is the one that most of you should be practicing and perfecting first. And then when you get the squeeze on, you go, well, that was good, wasn't it? Take a look at the buy trade reversal here. So when you're seeing this buy trade here, for example, now, obviously, if I buy down here, I'm trading from weakness. So I've got to try and establish some strength coming into this area. So I see an area like that. What's happened to the supply here? Well, the supply obviously was originally here. And what's happened to that supply? Well, the supply has been compressed into almost a slither of action right here. Very, very small area. Well, the smaller the area like this, the weaker the area is. The smaller the area, the grouping of stops is in this hole here. So when I see this price then collapsing back towards us, having rejected the breakdown, well, this isn't my buy trade, is it? This isn't going to be the buy trade here, Theo, is it? That's not a buy trade. And that's not a buy trade. Because at this stage here, this is weakness. This is weakness. You're trading towards weakness on the way down, but you're not trading from technically the right trade area here. If I wanted to take this as a sell trade, I would have been selling it where? I would have been selling it somewhere here, right, for the BSG squeeze. If I wanted to take it as a sell trade. Well, if I took it as a sell trade, I'd have scratched out for a zero, wouldn't I? It never worked out, but I would have still been able to scratch for a zero. If I'm looking at this weakness here, that's not a buy trade. That's not a buy trade. This is a Heisman trade. This is really the earliest you can take a shot at this. So that would be the Heisman trade. And then the tipping price trade. And then the BSG squeeze trade. 3 trades, trading towards weakness. And obviously when you've got that weakness, you're now off and running, and all you're now going to do is keep trading towards weakness from preferably a failed auction, because that way we've verified absolutely we've got in good shape. Now obviously I like to find more than just a pivot, and obviously a little very, very, very thin area of supply is always a great target price. Thick area is not so, but you can see how thin this area of supply is here. Look, it's really thin. So if I can trade towards that, the more I see this happening, the more stops are happening above this price, right? So there is a lot of weakness here. So obviously the idea of going after that could come from this rejection of this pivot. That would be a starting point. So we could obviously look at that and say, well, there's a Heisman trade entry there. We could obviously have a tipping price somewhere about here. And of course, on this occasion, the BSG squeeze never worked. On this occasion, the BSG squeeze never worked, and you're probably a little bit surprised at that. But, you know, not when you've came from a tipping price. So when I've came from a tipping price like this, generally I don't go for a BSG squeeze because you're not getting the right momentum at that stage. If I'm going to go for a BSG squeeze, it needs to have a solid failed auction behind me. That's the kind of trade you want to take as a BSG squeeze. So if I've got a spring trade, I'll take the Heisman trade or the tipping price, and I'll probably pass on the BSG squeeze because we've obviously seen some selling coming in. Otherwise, how did we manage to get a spring trade? So I'm going to take the spring trade as a Heisman and a tipping price, but I'm not going to take the squeeze on that occasion. Not going to. So you can see that that's exactly how this is played out. So this is where you take a squeeze trade. Right there. That's how you take a squeeze trade. Now, this one actually gave you the possibility of taking a squeeze trade, because if you looked at this chart here, you'll see that there's a red candle before the break. So we actually had a failed auction before the break higher here. So technically, we could have taken a chance on the BSG squeeze following that failed auction there, because then we've got, effectively, if I take this down, for example, to a 15-second chart, we would actually have effectively a sell-off, a pullback trade, and then a resumption of trend trade. And by going after the weakness, we then have a target price, because where's the next target price? Well, the next target price for these buy trades, on the basis that this is only the first target price right here, right? That's the first target price, is that price. So where's the second target price? Well, that's up to you, but there's a couple of levels you may have marked on the way back from the top edges. I don't think it's this level, because that level, that level didn't really give me what I needed, but I think it's probably this level here. So I think that's the realistic target price for those long trades. Now, if you called it as this price, I wouldn't have a problem with that either. If you called it from this price here, I don't have a problem with that. So this would be my target price here. And obviously, if I've gone in for a buy trade here, as soon as you start getting that buy trade, remember, this is now your target and your stop. So your target and your stop, obviously, if you're in it around about this price, then of course your stop is now, off the bottom edge there. And if this is your target price here, of course you're going to be going for that target price there. Your risk reward there is 4.8 times. So that's a 4.8 R on this trade if you get the full target. 4.8 R is not bad, guys. Not bad at all. I was just talking earlier after we'd just been cut off. Actually, I was talking about trade sizing and about the problems that retail traders have, and it's really interesting because when I started to look at these, and a lot of people were using 5% risk. Now I know when you're trading, to learn stuff, 5% risk might be exactly what you're trying to do, but you shouldn't be trading 5% risk. You shouldn't be trading 2% risk. The very maximum risk you should be trading is 1%. I'd far rather that on a stop loss you were trading between 0.2 and 0.5% rather than even 1%. Because guess what happens? Well, think about 5 consecutive. Is it possible with a very high win rate that you can have 5 consecutive losses? Yes or no? It's not just possible, it's almost definite, right? You're going to have 5 losses in a row. You agree with that? almost definite you're going to have 5 losses in a row. So on the basis that you can have 5 losses in a row and you're using 5% risk, you know you're going to have a 25% drawdown. How do you think you're going to feel taking trade number 6 with a 25% drawdown at that stage? Even if you're using 2%, you're down 10% of your entire account. How are you going to feel about taking trade number 6? And if that loses, trade number 7. But just imagine if you were trading 0.2% or 0.5% and you had 5 losses in a row. You're down 2.5%. 2.5%. How are you going to feel if you're down 2.5% of your account? You're going to hardly even notice, really, are you? If you're trading 0.2%, you're down just 1% of your account on 5 losses. So to be down 5% of your account is almost impossible. Now, I know that the journey is going to take longer, but it's amazing how compounding gains can work for you in that sense. That journey starts accelerating very quickly once you get on the compounding curve. So when you're starting out, you've got to make sure you are only risking something that you don't even notice, because then you're not trading with fear. You're not trading with worry. You're not trading with that horrible feeling in your stomach where you see 3 losses and you're suddenly saying, I can't take this anymore. Well, 3 losses and you're down 1.5%, or 3 losses and you're down 0.6%. You're not even noticing, guys. And I think this is where a lot of people are not getting success from, is because they're trying to make too much too early in the process. If you follow some of the guys that have been successful, they haven't always traded with size. They've traded with next to nothing. And their compounding doesn't even keep up, so that their percentage is reduced. Is that correct for most of you? So just because you double the size of your account, you don't double the size of your contracts. You don't double the size of your contracts. You maybe increase your contract size by 10%, but you don't increase your contract sizes by 100%. What does that do? Well, effectively, that reduces your risk percentage significantly. The next time you double your account and you increase your trade size again, and again the number of contracts doesn't go up by the same amount as the percentage, you've again reduced your percentages to the point you're trading 0.1, 0.2, 0.5% risk. At that stage, you're getting in good shape. At that stage, you're managing your money properly and you're giving yourself enough room to make the gains. You're giving yourself enough space to make sure that when a trade shows up, well, you're on it.